Listen-only mode.
Good afternoon, everybody. This is Stan for theartofchart.net, and I have with me Jack and our special guest, Mike Vaki from Princeton Trader. And we're doing a webinar today, and it's on trader psychology, both the pitfalls and remedies of trader psychology. Our disclaimer, of course, on theartofchart.net, everything we do is for educational purposes. We don't give trading recommendations or anything like that. We're here basically to support traders in learning how to trade, which is why we're doing this webinar. And to introduce the webinar, here's sort of our thinking in terms of how we're going to proceed here. And this is going to be more free form than anything else. And we encourage questions. And that's the thing about our webinars. We like the interaction. So, you know, in the question tab that you have, please put in your questions around trader psychology. We'll get to them. And so for about 30 or 40 minutes, we're going to talk about the pitfalls of trader psychology, you know, the psychology of trading and risk, and what is a trading mindset? What are the destructive elements of the psychology of trading, fear and greed, and we'll talk a lot about the pitfalls. And then we're going to switch gears and we're going to talk about remedies, things from having a plan, using rules, having a system, you know, how do you manage risk, and all the things that we lean on to actually be successful as traders. So I think that's really the introduction, guys. You want to throw anything else in the mix? Mike, Jack?
No, I think that's good. Let's go.
No, I think we're, yeah, let's go through it. I mean, this, you know, folks, thank you for coming. And I think that a webinar like this is critical. Whether you've been trading for 6 months or, you know, we get people that have been trading for 10, 20, 30 years that, you know, they fall into these traps every day. So I'm looking forward to it. Go ahead and kick us off, Stan.
Okay. The thing I want to say just to kick us off is that, you know, trading futures, people, there are all sorts of stats about it, like 80 to 90% of people lose money. And, you know, for me at least, one of the main reasons why I see a lot of people losing money, it's psychology, the psychology of trading. You can have the best, how can I say this? You can have the best technical analysis in the world and you can still lose money, okay, in trading very easily. So guys, let's start with the trading mindset, destructive psychology, fear, and greed. Let's just start with those four. And Mike, Jack, which one of you want to kick it off?
Mike. Okay.
Well, let me take the four of them together real quick, and then we can break them down. Because we get people from all walks. I mean, they're new, they've been around for a long time, they carry a lot of baggage into their trading. And the mindset with regard to your trading has got to be as mechanical as you can make it, okay? It can't be, you see a lot of people that are concerned with, they will take a losing trade into their next trade. Can't do that. That trade is over. You have to have the mindset where, you know, it's like being a closing pitcher in baseball. You go out, you try to get a save, you get rocked, and it's like, look, get back on the horse, get back in that old trade, or that system you tried 2 years ago, or that course you took way back when with that guy that didn't work and I lost all that money doing that. You can't carry that baggage into your trading for the present moment. You have to be, what is the trade? Number one, what is my risk? And how am I going to execute that trade? And that gets into a little bit of the remedies. The destructive psychology comes in when all of that baggage, those old errors. I tell people all the time, you've got to let all that other stuff go. You have to let all of that old stuff go, because all that matters is, where are you going to go from here? What's your plan from here forward? Okay? Whether that, you know, how are you going to manage your risk? How are you going to get into a trade? How are you going to get out of a trade? All of that, all of those old behaviors, those destructive behaviors, will repeat themselves again and again and again. And, you know, a lot of that is related to fear. Fear of losing money. Fear of losing money will get you out of some great trades really early and into some bad trades for much longer than you should ever be in them, because you don't want to exit, you don't want to be wrong, and you don't want to lose money, okay? Greed kind of plays into that as well. Greed is when things are going well. Things are going really well. I put together a day. We have goals in my room. We try to do 4 handles a day and things like that, and people start to be successful. And they say, okay, I've been successful. Instead of trading 3 contracts, I'm going to trade 6. Yep, because if I trade 6, then, 4 handles on 6 is a lot more than 4 handles on 3. What a lot of traders don't appreciate is that an alteration of your plan, whether it's an adjustment of your risk model, how you're going to get in, how you're going to get out, how you're sized, is going to change your psychology toward your trade. It's going to adjust the trading mindset. Okay?
Absolutely.
I guarantee you, the first day you trade with double the size that you traded yesterday, your eye is going to be fixated on that little green light, and you better hope it's a little green light with your P&L and not a little red light. Because if it's a little red light, those plans that you had when you were only trading 3 are going to go right out the window, and you're going to do one of 2 things: fear. You're going to get out of a good trade quick because, well, I'm up 2 handles, I'm out, I'm done there. Whew. And then what you'll see is the trade will continue in your direction. You'll revenge trade it, because, hey, you're out. I'm out of the short, so I want to be long, right? Because, hey, I'm not short anymore, so we're going to go up. You have preconceived notions, okay? And then the other thing you'll do is, if you're wrong, after you've altered your mindset and greed and fear become involved, is you'll say, oh, I can't get out now. If I get out now, I'm going to lose, X amount of dollars. Now, I don't want to take too much time here. The last thing I'll mention is, if you think of your trading in terms of dollars and cents, I made X number of dollars.
Mm-hmm.
You're already, in my opinion, you are already very much behind the 8 ball negatively with respect to trading mindset, and you're in a destructive psychology. Trading performance should be measured in handles. How many handles of a particular move did I capture? If it was a 15 handle move, did I get 10, 11, 12 handles, or did I only get 2? Not I made or lost X number of dollars. If you think about it in terms of dollars and cents, fear will control you.
Mm.
Okay.
Yeah, very well said. Very well said.
Go ahead, guys.
Yeah, just to build on what Mike said, I think one of the number one things that traders take for granted, number one, is stress. And the example you gave, Mike, I just want to build on it. It's like, hey, I just did a 3 contract trade. Well, boy, I'm going to do 6 now. And do you have a sense of the stress that you're experiencing when you're trading? Okay, and if you aren't monitoring your own stress, when you don't know, like for example, one of the disciplines I have is, if I have a loser and I feel that I'm stressed, I walk away. I walk away from the keyboard until I recover, sort of a normal state of mind. Because you cannot make rational decisions if you're stressed. Okay, if that caveman inside of you has gotten activated, okay, because you've lost money or whatever activates you. Everybody's different. Every human being is different, right? But if you get activated and you're in a stressed situation, I'm sorry, you could have the best trading plan in the world. You're not going to be able to execute it. So you have to have the discipline to know when to step away from the keyboard. And you also have to have the discipline to know how to size your trade, because size has a direct correlation with risk. And I think that taking too much risk is how traders get themselves in trouble. And very often people do that early on in their trading career. And I think the worst kind of trader is the one who has success early. Okay, I was the guy who had no success early. Okay. And I learned some very valuable lessons from losing a lot of money. And guys, that's how you learn about psychology, and that's how you learn about yourself, frankly, in my opinion. So, so Jack, I'm sorry. Let me let you take a crack at this.
Yeah. I was just going to build on that and say, actually, it's watching a webinar like this is an opportunity not to learn from your own mistakes. It's an opportunity to learn from other people's mistakes. Because some people can only learn from their own mistakes, and some people can't even learn from their own mistakes. So, but ideally, you can actually have a look at this, recognize things which can be problems, and because a lot of the stuff we're talking about is pretty universal, and most traders will recall thinking that at some time. It's first off, I would say on trading mindset, the most important thing to consider about trading is, remember, you are playing in effect a game of skill for money. You have to be cold always. There are a number of things you shouldn't be when you're trading. You shouldn't be angry. You shouldn't be really happy. You shouldn't be. You have to trade everything cold. You are playing a mathematical game. You are playing by rules. It is a game of skill, and you have to choose your entries. You have to choose your exits, and you need to play it in a way which allows you to maximize your chances of making money on it. A lot of people don't do that. They trade when they're scared. They trade when they're desperate. They trade when they're angry. You know, I have just lost money and therefore the market owes me X. The market never owes you money. The market doesn't care what you want. The market will not come back because you want it to. It will never do anything because you want it to. The reality is either you are playing your game of skill with skill, or you're just throwing money away. Because any of these things, trading desperate, trading scared, trading angry, trading really tired. You've got to remember, you know, if your brain's not functioning properly, if you haven't had enough sleep, if you're upset for some reason, if you're ill, these things can all seriously affect your trading. And of course, that is before, you know, and don't drink and trade. Absolutely, really.
Come on, Jack. It's more fun that way.
Yeah, until you wake up afterwards. It's
yeah,
like,
right.
I do. It's but the thing is, you are playing a game of skill, and you need to be able to play it well. And you'll play it well if you play it cold. You've got to have a plan. We'll be coming to that later, but you've also got to trade. You've got to trade it on an even keel, and you've got to be weighing each decision and weighing each trade rationally. Anything which is attacking your rationality, like I've lost 4 handles today, I've got to make them back. The market hasn't got to give you a damn thing, and if you go in and without a plan because the market owes you money, then you're just going to lose more money. I mean, you might sometimes make it back, but more often than not, what you're doing is you're forgetting your discipline, you're forgetting your plan, and you are starting to play the game without skill, and that is just a recipe to lose money.
Absolutely agree with that.
I mean, what happens there, and what Jack is alluding to, is when you get off of that, you end up taking, instead of a great setup, you're taking any setup. And when you start taking any setup, it's probably not that good of a setup. And Jack makes an excellent point here. Scared money. If you're scared money always loses.
Yeah.
Scared money always loses. If you're trading like you're trading your last dollar, you might as well just forget it. Just tear it up and throw it away. And I made some notes here. Stan made an excellent point. Trading is all about self-awareness, okay? It's huge. It's everything. You have to know in your mind going into any trading day, okay? You need to have a plan. And you need to have an overall plan for what are you going to do when you get stressed out? What are you going to do when you take a bad trade? What's your plan? How are you going to reset your head? And it's different. Like Stan said, it's different for everybody. I've got guys that go for a walk. Some guys literally go mow their lawn. You go for a drive. They go work out. They come back. They get their head straight. Sometimes it takes some people 15 minutes. It takes some people a day.
Yeah,
okay?
right.
But what's important is to get your head straight and get back in your trading mindset, and then you are ready to trade again. You are an instrument of trading, and if the instrument is broken, or if the instrument is not, if it's not tuned correctly, you need to go do what you need to do to get it back on track. Jack was mentioning about being sick. It goes, sick kid at home if you trade from home. Don't trade. You get in an argument with your spouse. Things are stressed out and you're angry, you're upset. Don't trade. Death in the family. Don't trade. New baby. Don't trade. These are all things that I've seen over the years. These are all, I deal with this stuff every day with our subscribers. All that stuff will get in your head. All that stuff. If a business partner ticked you off, you're in some kind of a deal or whatever. It will all affect you. And you've got to get all that out and get your trading mindset where it needs to be so that you're respecting your money with proper size and proper risk. The first question in any trade should be, what is my risk? And if your first question is, I've got to make X out of this trade, how am I going to do it? You're already done.
Yes, right.
Because a lot of people will do exactly the opposite. The more scared, desperate, or whatever they get, they're just thinking to themselves, I cannot afford to stop digging until the hole disappears.
Right. And guys, let's talk about rationalizations, because the people that I coach who hit me on the side, or the ones who send me emails, or even the guys that I'm actually coaching, they have a way of rationalizing what they're doing, and it makes complete intellectual sense. Okay, so there's a gentleman I was working with recently, and what he did is he said, yeah, I'm in a really bad trade. I'm trading oil, right? And this was when oil was really hitting the downside pretty hard, and he was way underwater. And I said, so what was your plan? He says, well, I thought it was going to bounce. I mean, that was his plan. So there wasn't much of a plan there. And he rationalized that it would eventually bounce. And what he didn't realize, for example, was that he was afraid of losing money. He wasn't in touch that he was afraid. And I think people rationalize. I see rationalization happen a lot, and underneath the rationalization is either greed or fear most of the time. And I know you guys have seen this, and I think one of the best way for people listening to connect to this is to hear some of the rationalizations that we've seen and that actually we experience ourselves. I mean, I'm just as human as anybody else, by the way, and I'm not a perfect trader at all. And I rationalized something the other day. We were in a triangle in gold. And I even said this on the video. I said, I'm going to break one of my rules. Okay, this RSI thing, it really did cross the line here, but I'm going to ignore that. And what happened? You know, I rationalized something because I was married to a certain outcome. I didn't have I wasn't free in my own mindset around, you know, this could go either way. I was married to an outcome, and I rationalized what I saw. I mean, it was a dead giveaway. It was right there in front of me, and I even rationalize myself out of smart decisions very often. So let me let you guys respond to that in terms of rationalizations, your own, but also what you see in trading in general.
All right, Mike, do you want to go first, or?
It's up. You can. I mean,
I'm ready. I'm ready.
Go ahead. Go ahead. Go ahead.
All right. Now, one of them I was talking about on my blog the other day. The whole idea of certainty. There is no such thing as certainty in trading. And frankly, there's not a lot of it in life either. It's if you absolutely have to have a certain outcome, then it's going to be the bad one. I had a letter published in The Economist back in the 90s. I'm sure it made a lot of people laugh. And I was talking about the nature of risk. And I said that whenever you had a certain outcome, it was the bad one. And I said, and you could always choose the bad one, whereas you generally had to take a risk for the good one. Pretty much that applies across the board. And the example I used was, I said, who reading this letter could guarantee they'd be alive in 24 hours? Nobody. But more or less anyone with access to a weapon could guarantee they'd be dead. That's and that's a fair comment. If you want the guaranteed outcome, it's going to be the bad one. There's no such thing as certainty with a good outcome. Mm-hmm. There really isn't. It's and that's one. I've got another one. And we need to talk a bit more about rationalizations and amateur economics. Mike's probably the best one to talk about that, to be honest. But uncrystallized losses on real losses. And this is the there's a whole string of rationalizations about when you have a losing trade. You know, I'm going to keep it for a long time because it's on a different time scale. Did it start out on a different time scale? No. Why is it on a different time scale now? Because it's a loser. It's and there's a whole
and what's underneath that is fear that I'm losing money. Oh, it's not really a loss. Okay. See, unless you're able to see it in yourself, then you won't be able to get past it.
Yeah, but the thing is, of course, it's still real money. It's still real money leaving your account. The value of your account is reducing. If you have a trade which isn't a loss of, 10 handles because you haven't exited the trade, then you're doing two things that are really bad. One, you're choosing to stay longer in your worst trades. a strategy which is unlikely to end well, as I'm sure a moment's thought would tell you. And the other thing is you are risking the loss that isn't real becoming a much bigger loss that isn't real. And at some stage that loss is going to be real. Even if you hold it for months, sooner or later you're going to have to roll it over into the next contracts, and it's sure as hell going to become real then. It's the fact is there's no such thing as a paper loss. And the sooner you just accept that, whatever the numbers are telling you at the time, what you've got to work out is not, am I prepared to take the loss, but is it actually worth me staying in the trade? Related to that is adding to losing trades. Now this actually, for very simple reasons, is an incredibly bad idea. Because if you think about it, if you're adding to your losing trades and not adding to your normal trades, you're basically cherry picking your worst trades to be your largest trades. Obviously, it doesn't take Einstein to work out that mathematically that's unlikely to work out well. Just because you've added to it doesn't mean it's any better as a trade. You've added to it because it was a loser. If it then doubles in size, what you've managed to do is actually, rather than just have a doubled loss because you didn't exit when you should have done, you've now tripled it. Yep. Because the second half of the loss you've doubled up on. It's just a really bad idea.
And that is typically a lack of self-awareness that stems from maybe I don't want to be a loser, or maybe not being aware of your own fear of losing money, or recognizing that you've lost something. So you really have to get in touch. And by the way, it's different for every trader. There's no set rules around this, folks. You just have to realize that. But you got to really dig down inside and figure out, so what is this that's driving this in me? Because if you don't do that, you'll do it again, and then you'll do it again, and then you'll do it again.
Yeah. The majority of traders that I run into who add to bad trades, I always ask them why. Why are you adding? Why are you adding to a loser? Mm-hmm. And once you peel away the layers, what you find out, everybody, is the majority of people add to losing trades to make themselves feel better, so that their dollar cost average on their trade is a heck of a lot closer to where the market was before they clicked the button. Have they resolved the actual problem? No. So they'll do it again and again and again and again. The stress heightens and heightens and heightens. You are way oversized, and you've done it all because you don't want to take a loss. Yeah. And so instead of taking a small loss, you're going to take a big one. And something interesting that Stan had mentioned about rationalization. And I get accused of a lot of things. I get accused when the market's going down, I get accused of being a perma bear. When the market goes up, I get accused of being a perma bull, because I literally don't care. I just want to make money, which is the mindset that you've got to strive for. Nothing makes more rational sense than the bear case in any market, whether that's the E-mini, whether you're talking about the S&Ps, whether you're talking about gold, oil. The reason for something going down usually makes a heck of a lot more logical sense than the reason for it to go up. And that's the trap that people have fallen in the last 5 years during this uptrend. And Jack talked about amateur economics, which he knows where my buttons are, and one of my buttons is amateur economists. And these are some of the things I just jotted down, a few that I've heard over the years. Newsletter X says that. Okay, you read something. I was reading The Economist this weekend. The Fed will do this. The Fed will do that. This is silly. It's done going up. It has to come down. It's done going down. We've gone up X number of handles in so many days. When you start rationalizing, when you start telling me what you read in The Economist this weekend, I don't want to burst anybody's bubble, but your amateur economic opinion matters not to the market. And your economic theory about central bank policy, the supply and demand of oil, whether gold is the real deal or what, has nothing to do with trading it. Trading it needs to be mechanical, with a mindset that you want to make money. You have to replace the desire to be right with a desire to make money. If you can do that in between your ears, if you can adjust your brain to where your priority is to be profitable versus being correct, you will be a long way towards being a successful trader.
Yep, agree.
Yep. Just to throw in a couple of examples on that. Actually, no, do you want to go ahead, Sam?
Well, go ahead, Jack, please.
No, shoot, go on.
I was going to say that there's something important that that Mike mentioned. I just want to pull it out and kind of highlight it. You're going to make mistakes as a trader. Trading is about losing. Okay, it's about making money as well, like Mike said, but it's about losing. 30% of the time you're going to be wrong. Are you the right kind of person to trade? Can you be wrong and be okay between your ears? Okay, I'm wrong 30% of the time, and I make no bones about it, and that's just fine, because the other times I'm right and I get out of my losers really fast and I don't carry them. So, I think you got to face the facts. You're going to be wrong, and you got to recognize when you are wrong, and you have to have that in your plan, and you have to be able to exit expeditiously without carrying losers. And I think that's the thing about that. That's the cure that cured me years ago, because I used to carry trades, swing trading. I mean, I carried trades in the NASDAQ downturn in 2000 and 2001. I'm going to tell you, I got hurt pretty bad because I was carrying trades. And what I learned is that, trading is about losing. You have to know how to be a loser in order to be a winner. And I know that sounds sort of counterintuitive, but it's very, very important. Okay, so I had to throw that in there because, you can't always win and you can't always be right. It's not possible.
No, and actually, it's the difference in military terms between just throwing down your weapons and running away in all directions and doing a fighting retreat.
Yeah.
One option gets everyone massacred, and the other one leaves you to fight another day.
Yeah.
So what you want to be able to do when you have a losing trade, you want it to affect you as little as possible, and just move on to the next one, which is likely to be a winner. So in terms of, I just wanted to talk quickly about the amateur economics. The fact is, there's so many people wanting to do it all the time, and it's very easy to do. That's part of the problem. Even the professional economists. I mean, look at the Fed. They're packed with PhD economists with written books and all sorts, and they are absolutely clueless. They've got no idea what's going on. They've never had any idea what's going on. Their policy over the last 25 years has mainly just been lurching from one crisis to another, which they have really helped create. And these guys are the professionals. The amateur economists are likely to do worse. No one is ever going to be a successful trader being an amateur economist. So it's worth giving that up. And the other thing is that a lot of what you read, and when you're reading The Economist, I've got greatest respect for The Economist, and I very much enjoy reading it. But the fact is, we've got a media, and their job, in terms of the financial media, is to take the stuff that's happening in the markets and to take the stuff that's happening in the world and weave them together as cause and effect. It doesn't mean there's much relation between them, and it doesn't. And just because theory sounds good does not make it a credible one. And if you trade on the basis of an economic theory, I mean, again, it could take years to happen anyway, even if it does happen. If you're, and this is one problem with I am a bear, I am a bull. One, it's not a team. It's not football. All that matters is making money. It's not a matter of your team winning. If your team's, well, if you're losing money, it doesn't matter whether you're on the right team or not. There are no teams. Basically, you're focused on making money or you're not. And the second thing is, many rationalizations are complete bollocks. Very good example, all right? End of 2013, some of you, actually, if you've been reading my blog for a while, will remember this. End of 2013, QE3 was winding down, or was it, yeah, end of 2013. It was coming to an end, and there was absolute unanimity that because the Fed was going to stop buying bonds, therefore demand for bonds was going to go down, therefore bond prices were going to go down. And everybody knew this was going to happen in 2014. Everybody. There was a poll of 75 economists, and all 75 forecasted lower prices. In some Bloomberg or something. And all of them forecasted lower prices in 2014. The Fed was making statements about how it was about the possibility of negative effects from bonds going down in 2014. And I was preaching the opposite case, and at the end of 2013, and no one would listen. Politely incredulous audiences, you hear what they were thinking. They were thinking, well, you've done some nice work in the past, but obviously you're totally off on a limb here. You've lost the plot. And what the point I was trying to make was, it doesn't matter about the rationalization. It sounds great, but the next question is, so what happened last time? Because the reason they called it QE3 was because there was a QE1 and a QE2. What happened in those cases? Well, at the beginning of QE1, there was a big decline on bonds, and at the end there was a big rally. And the same thing happened on QE2. And at the beginning of QE3, there was a big decline in bonds. Now, what is your obvious conclusion there? You've got to at least be aware that there's a possibility that you might have a big rally up bonds at the end of QE3, and that's exactly what we saw. And the pattern setup was favoring it. It was telegraphed in advance, and everybody missed it. Because they were all seduced by this rationalization that was put forward in the press that the Fed were endorsing, and it was just garbage. Loads of people did their last trades on that one. They bet the farm that bonds were going down, and bonds went on a major rally. It's that's got, and there are a number of issues there. One, economics, trading through economics is garbage. Two, much of what you read in the news is rubbish. And three, a nice-sounding rationalization doesn't have to be, just because it hangs together logically doesn't mean it's true, and it's got no relevance necessarily to price. All right.
Okay, let's shift gears, guys, and talk about something that typically a lot of people don't write about or talk about, and that is self-talk or coaching yourself when you're trading. Okay, and I'll give an example, and I'll give an example from today. So this morning on our private Twitter feed, I said something about how the market was going to bounce, et cetera, and watch for the weekly pivot at 2025 on ES, yada yada. And what I did is I got long, and then when we hit right about the weekly pivot, I got out. I exited. Okay, and I was watching to see what the market would do next, because that was basically my plan for the day. That was it. Okay, so I executed my plan. And what did I say to myself? Good trade. Okay, and I actually do talk to myself. I said, that was a good trade. Okay, the market continued to go up, and the market on Monday could go to 2056. Am I going to say to myself, oh, I missed the boat, oh, I got out too early? Will I say that to myself? No, because I executed my plan. I did exactly what I planned. I made handles, and it could go up another 20 handles, and I don't care. Okay, and that's what I'm talking about in terms of coaching yourself. It's like there's destructive talk that people get into when they make trades, and so I'm interested in your coaching yourselves, guys, or just self-talk in terms of if you make your trade and you make money, it's a good trade, folks. If the market continues to go higher, don't beat yourself up over it. Okay, or if you miss a trade, you miss a trade. And if it's not part of your plan, then why are you beating yourself up over that? The market ran 20 handles and you missed it. That's not the point. The point is, before the market opens, you got to put together a plan. You got to have a sense of where your support and resistance is and what risk you're willing to take, and then you got to execute your plan the next day. And if you execute it and it works and you make money, you should be complimenting yourself, saying, guys, or Stan, you did a good trade. Well done. And no matter what happens after that, guys, it doesn't matter, okay? Because you've done what you planned and you made money. I think that's the main thing, because a lot of people have this hindsight. How do I describe this? This self-destructive hindsight. They actually make a good trade and then they make themselves wrong. And I've seen that a lot. What do you guys think about coaching yourself and self-talk around trading?
Yeah, no, I think you're absolutely right. I think you've got to be able to review what you've done. You've got to keep your expectations realistic. And Mike, I'd like you to give the realistic expectation speech. Mike?
Yeah. Okay. So, I hope I'm going to give the right speech, because this is the one I give all the time. We get people that come in, and I already mentioned, we over at Princeton Trader, we have one stated goal. We try to do 4 handles a day, on average, 4 handles a day, 20 handles a week, 80 handles a month. It's, it's attainable. It breeds consistency, and that's, and that helps with that positive self-talk. I have people come in all the time. Well, I want to do 15 handles a day. I want to do 20 handles a day. And it's like, well, that's nifty. We all do. And what will happen is your expectations will become so unreasonable that you could be doing 8 handles a day. But if your goal is 15, you're not going to be doing the positive self-talk that Stan is talking about. You're going to be acting like you're not performing. When I tell you right now, you are outperforming 99.9% of the future traders out there. Okay? You have to set reasonable goals. Your goals have to be attainable, they have to be reasonable, and they have to breed consistent success. Because in consistency, there's repetition. In repetition, that's how you develop systems that work, risk systems that work. You find that you can take a loss, okay? One of the things that we do is we take, and understand, you have to understand time frames. A lot of what I do is day trading. But one of the things that we do is when we get 2 handles up on a trade, we take a third off or 2 and we get our risk out. And sometimes we come back and we get stopped out, but we'll go again and again until we get, till the move does what it wants. What I've found is in getting your risk out, in turning those those trades into little victories, instead of sitting around in one trade, watching it go red and green and red and green, we're going to make a bad decision. I find that my traders look back at the end of the day and they see a lot of positivity there. And those little trades add up. They add up to hit those goals. Sometimes, and then, we get runners and I have, we get the middle and we get the runner going, but all of it is done in order to achieve what is a very reasonable goal, and a goal that breeds, consistency, and, that's how you can coach yourself. You have a plan. What's your plan? How many handles do you want to make today? What, or do you not want to trade today? Are you looking for a particular setup? You can look for one particular setup in a day if you want to, if that's your thing. But if you don't get it, then you don't get to trade today. Okay?
Yeah, right.
That was your plan. So whatever your plan is, you need to stick to it. Okay?
Yep.
The way I do trading plans is I have in my head a set of either-ors. We had the weekly pivot today. Okay? Either we were going to hold the weekly pivot and bounce, or we're going to break through. We broke through. We broke below. We were going to get a rally. Then the issue became early this morning, before we even opened, was one of our proprietary indicators, was it going to be resistance or was it going to break back up? It held as resistance, so we got short, rode it to a lower low. Then we started to see the moves going higher. So it's all either or, either or. Traders have unreasonable expectations when they think that they have to trade a lot, or they have to come in and make all these handles, or they have to trade huge size. You have to keep it reasonable. If you don't, you can be succeeding and you think you're failing.
That's a very good point.
And if you do that, then you're going to try and improve on your already good performance and try and make it better, and chances are you're going to make it worse.
And the thing to add to what Mike said is you have to be able to do a plan that you are confident in executing. And I think the thing about trading is you have to have a confident mindset. It's like if you can have little winners and then look back on the day and say, I made money today, you go into the next day even in a better place in terms of being able to trade. So, if you try to bite off more than you can chew, okay, like for example, everybody right now is looking for a, quote, big short. Okay, there's a lot of resistance up here where we are, and everybody's looking lower. Okay, and so are you confident that you can make a couple of hundred handles in a single trade? Well, I sure am not. I'm much more confident in making 2 to 4 day swings, and that's kind of my bag. Okay. And I feel real comfortable in that space, and I'm very confident in that space, and that's what I know how to do well. So am I going to get out of that? No, I'm going to trade what I'm confident at trading. Okay, and so the little winners that Mike mentioned and all the other little things that we're mentioning, it adds up to you being able to trade not in a stressed out place, but in a confident mindset. And by the way, that's different for every person that's listening to me right now, because you might be a great scalper. Well, I'm a terrible scalper, okay? And other people might be great long-term traders, but I'm not, right? You got to recognize where you fit in the trading world, and there's a lot of different spaces, guys, and you just have to find your space and find what works for you where you can trade with confidence, because without the confident mindset, then you fall into the destructive psychology stuff. So that's what I wanted to say about that.
You have to set yourself up to succeed.
Yeah.
You have to have a realistic plan to succeed. So setting unrealistic goals, there's a number of other things. You've got to have, it's a game of skill. You've got to know where your skill is and be using that. So you can't, if you feel that you're not working because you're sitting in front of your screen and you're not in a trade, then that is a major psychology foul, because you'll then get into a trade because you're feeling that you need to be in something. But actually, as soon as you do that, you are making a trade which has no setup. You've just got a feeling it might go up or a feeling it might go down. That's not trading with skill. Anything which leads you to trade stupid, and trading without a plan is always trading stupid.
Yeah, I agree.
Anything trade stupid is bad. You have to be able to sit in front of your screen, watch carefully, and wait. And the setups happen when they happen.
Yep.
You cannot push a trade into happening.
Yep, that's right. Let's talk about systems and rules for a minute. And guys, if you have questions, post them. We're going to get to them. And let me just kind of kick this off. Okay, so one of the things that really helps with psychology is to have support. Okay, one of the supports, of course, is like being the person. And I think Mike has this great language. And I'm trying to remember it, Mike, but I think you call it being the 10 o'clock person, the 10 o'clock guy. Okay.
Yes.
So you're not trading. You're looking at charts, you're figuring out the plan for the next day, and maybe you're looking across the market because maybe you trade multiple instruments, because I think trading one instrument is very difficult, okay, for me personally, okay? I'd rather look across the market, find setups, okay, then figure out which setups I'm going to use, have a plan for the setup, then show up the next day and execute the plan and use a system. Now, Mike was alluding to a system, okay, for entries and exits, okay, where he puts something on and he risks two handles, and then he takes a third off and takes another third off and then takes the final third off. And there's a whole system to that which Princeton Trader uses, which I won't recap here. But you need to have a system. Now, the thing I want to say about systems is this. Are they back tested? Do you know that they work? Do you understand what instruments they work on? Now, most traders don't take the time to do any back testing of any systems. A lot of people believe, for example, that Elliott Wave is a system. No, it is not. It is an analytical technique, right? Classical analysis, is that a system? No, it is not. Okay, so there's the side of trading that has to do with understanding the possibility of where price may go, but there's the other side of trading, which is actually executing trades, which requires you to have a system. If you're trading without a system, you're just, I think Mike had a really good analogy. We were kind of BSing before the recording, and he says it's kind of like throwing money on the barbecue. You know, it's you're really burning money if you don't have a system. So you have to develop a system to actually support yourself in getting into trades, taking profit inside of a trade, knowing when to take off money and add money, but also when to exit. And if you don't have rules, and if you don't have a system, and if you're kind of playing it by ear, guys, I'm sorry, you're putting yourself at risk, and you're putting your money at risk, in my opinion. So let me get your comments, guys, on what you think about systems and rules.
Yeah, I think that's right. The reality is never ever confuse analysis with trading systems. They're not the same thing at all. You could have a very good idea and be right most of the time about where price goes, but lose money on every trade, or at least lose money on average, because you're just managing your trades badly. You've got to have an idea of when's the best place to enter, when's the best place to exit, you know, legging in, legging out, the easing into a trade, easing out of a trade, when you take profits. If you just do it in an unstructured way because you know where everything's going to go, then the reality is the chances are you'll get crucified. If you know that, I mean, for instance, if you're confident right now, which I am, that SPX is going to be retracing quite a bit and going down over the next couple of weeks, so does that mean I just slap a load of money on at any level and just wait? No, not unless I've got a very high appetite for losses, because one of the things, you have a process, you've got a trend. When the trend then reverses, you're in a turning market then. During that turning market, for instance, you come down, you get a spike down, and I was talking about this on my blog this morning, and then what happens then? You have to form a reversal pattern. 70% of reversal patterns on SPX are double tops and double bottoms. And that means that an awful lot of the time you're going to get some kind of a retest of the high. So if you dive in short on the first serious move down, chances are you're going to be sitting underwater on that trade for quite a while, or at least the major risk that you're going to be.
Yep.
You have to have some kind of plan about how you get into that trade and how you get out.
Right.
If you just sit in there and you're thinking, oh, it's going to go to anyone who was sitting in a big short at 1810 thinking it's definitely going to do 1750, potentially, if they were really confident and they just wouldn't get out of it, they could be sitting there now, 250 handles north, still thinking, well, it's going to go back, probably. And the reality is you cannot allow things like that to happen, because as Mike says, the whole point is to make money. You have to have a system for making money, minimizing your risk and maximizing your rewards.
Yeah. So let me give one example of a trading rule, okay, just so people understand what we mean by that, Jack. So like, for example, right now on our charts, if we said, this is a good area to get short, okay, fine. So what are you trading against if you're going to get short? Okay, you got to trade against something. So what is it that you're trading against? What is the level at where that you're wrong? So, you might say, okay, I'm going to put some on here at 2028, and I'm going to put my stop one handle above the current high. Okay, now that's risking a lot of handles. Okay, now a lot of people may not do that. It may not be your trading style, but then you have to say, okay, if I'm risking that many handles, what is 2% of my account and how much can I risk? Okay, so anytime you go to make a trade, you have to trade against something, number one. Number two, you should never lose more than 2% on any one trade. And number three, in terms of trading rules, you should never risk more than 20% of your account unless you're an excellent trader and you have a history of repeatability and you know exactly what you're doing. Okay, so those are just some basic guidelines, but I think you got to have rules for entries, like I've just described, that help you manage size, but you also have to have rules for exits. And so some of the rules that we talk about for exiting is, usually typically, like for example, well, let me stop there, guys, and have and Mike, let me hear you comment on some of the rules that you use to support yourself and also to support the traders that you work with.
Okay. Well, we talked about, how we like to take profits. So let's say, for example, where's the market trading right now? Where did we close? They closed at 2030. Okay. So say we're going to come in and we're going to short 2030. Okay. And what we use in the room are called risk markers. They're not stops. I don't like stops in day trading the E-mini. If you're using tight stops and trading the E-mini, then people are just coming and taking your money constantly. What we do instead is we come up with a level. In this case, I would say 32 sounds good. We'll use that as an example. So short 30 with a 32 risk marker. If that 32 converts, you don't want to be short anymore. It's going to go up and probably do 37. Okay. So what we do is we apply 2 layers of risk. We say, okay, this is our risk marker. If that risk marker is converted, then we have our eye on the exit door. And what we see is typically, the marker will break. It'll head back towards your entry. And that's very hard from a trader psychology standpoint, because if you've been in something that's down 2 or 3 handles and you see it come back to within 2 or 3 ticks of your entry, but it just can't quite get through, you have to have the discipline to cut it. Okay. The other thing that we always say is to have a stop. What is your line in the sand stop? For some people it's 4 handles, some people it's 5 handles, and you need to set that and you need to stick with it. Don't rationalize it. Don't bargain with yourself. Don't come up with plan B or plan C, because plan B or plan C is not the plan. It's a different plan. It's usually on a different time frame, and it's usually, kind of a disaster. So we but we're in a very short time frame. Okay, so we use risk markers and we have stops to back those up. and what we do is we trust in our win percentage. We trust in the fact that, historically I run about 85% historically, and the 15%, this is going to happen. And the key is you take that 15% and you get the heck out. You take the hit because you're going to make it back and then some on the ones that are going to work. And you have to trust in your system. You have to trust in yourself, and you don't, this is what I see a lot with newer traders. They have a few good days and then they have a bad day or a couple of bad days. And then what I hear from them is they've scrapped everything. They've scrapped everything they were doing. They're completely reinventing themselves because it's Tuesday, and on Tuesday we reinvent ourselves as traders.
God, that's the worst thing you can do.
And we're going to start over today as this new trader, and instead of being a swing trader, I'm going to be a scalp trader, and instead of trading the ES, I'm going to trade the NQ, or I'm going to trade gold, but I'm only going to trade it in the morning, and then I'm going to, you guys, I mean, yeah, I hear them all. Stick with what you're doing, focus on risk, shoot for consistency, and trust, what you're doing. But like Jack says, or like Stan says rather, Stan was talking about, you better back test it. You better know that what you're doing is going to work, and you need to lean on people that have been doing this a long time.
I agree.
And other people that are in the same boat as you. Don't trade in a vacuum. It's a very dangerous thing. The last thing I'll mention is the conversation that Stan and I had way back when, and this is for longer term swing trader, positional trader folks, which I don't get a chance to deal with as much as and I kind of missed that. The discussion was, be the 10 p.m. guy, okay? The 10 p.m. guy is sitting at his desk with all of his charts, or her, and they're looking at everything, and they're saying, okay, this is my plan headed into tomorrow with respect to the mini, oil, gold, copper, whatever it is that you're going to be doing, okay? You come up with a plan, you have a plan ready to execute. Bell rings the next morning. You're no longer 10 p.m. guy. Now you're 10 a.m. guy. 10 a.m. guy gets nervous. 10 a.m. guy starts to wonder, what's happening, and starts to flail around and make, decisions that 10 p.m. guy would look at him and say, what are you doing? We had a plan. Follow the plan. It's a good plan. But 10 a.m. guy's like, well, I'm reading this thing is on the wire, and this is doing this, and when objectively on the chart, nothing has changed. Nothing has changed to affect the original plan.
Right.
The only thing that's changed is your trading mindset, going right back to where we started.
I have never heard you.
Mindset, destructive psychology.
Right. I've never heard you talk about. Yeah, I'm sorry, Mike. I've never heard you talk about the 10 a.m. guy before. That's actually
the 10 a.m. guy. Can't trust the 10 a.m. guy. The 10 a.m. guy is all over the place.
That is absolutely comical. I have to tell you, it's great.
10 a.m. guy. 10 a.m. guy is scared. 10 a.m. guy wants to make all the money in one trade, or he wants out, and it's true.
Yep.
10 p.m. guy has a plan.
Yep.
Lean on that guy. We have both people inside of us as traders.
That's right. That's right. Well said. Well said. I think it's time probably to get to some questions, and let's see if we have any. I have a comment here. I'll read to you guys, and if you guys have questions, let's have them now. But the pressure/stress of having to make 3 handles per day isn't always realistic, setting you up to make bad decisions. And I think by the way, he does comment here, he or she does comment here, it depends on what kind of market day it is. I think there's one thing we haven't spoken about, guys, and that is waiting for the setup. Okay? Yeah. And you don't, and one of the most difficult things in trading is not trading. Yeah, I'm sorry, Jack.
Yeah. No, I did. I was just mentioning I did refer to it quickly because I was talking about not feeling that you have to be in a position because you're sitting in front of your computer. Because that's a really, either you're waiting for a setup or you're trading stupid.
Yep.
New traders think that if they're not in a trade that they're not working, and that's not true. Being out of the market is also, is also a position. Don't feel like you have to make 3 every day when I say 4 handles on average, I mean on average. There's days when we do 35. There's days when we do 2. There's days when, you know, it just doesn't happen at all. There's days where we're red. But you have to look at the consistency in, you know, over time, you want to be able to hit a level. You don't want to feel pressure if you haven't made X handles by 2 in the afternoon. You have to trust in your plan and trust in yourself enough to say, it's just not working for me today. I'm not seeing it well today. I don't like it.
Right.
I'll come back tomorrow. Forget it. You know, and that's the evolution of a trader.
Yeah, there's
the market. That's more.
Yep, that's right. And by the way, there's always a better trade, guys. Always. And one of the things you might want to try, and this is something to try trading less. Force yourself. If you make, I'm going to pick a number, 30 trades in a week, try cutting that in half. Force yourself to cut the number of trades you do in half just to see what happens for a week. Okay, I think you'll be surprised as to how picky you'll be as to where you put your money and how long you're going to wait for the right setup. Okay, so just try that for a week. Cut the number of trades that you actually make in half. See what happens. Okay, other questions? Okay, guys, anything you want to say to close? While we're waiting on people to post additional questions, we only have one comment that I'm showing right now.
I've got a couple of other things,
Sure.
minor things really, that I missed earlier. In terms of trading psychology, you've got to remember that actually what you are doing is trading involves training your mind to do things that don't come naturally. Recency bias is a very good example, and this is the tendency to think that because price has been going up that it's going to continue to go up, and that because price has been going down that it's going to continue to going down. The natural, and it's entirely natural, very human, and it gives you the natural propensity to buy at the top and sell at the bottom. What you need to be training yourself to do is buying low and selling high. But the natural inclination is to do exactly the opposite, because after all, it's been going up. I mean, I was getting this the other day. I was talking to somebody and they said, oh, you know, the market's up 240 points or something. You know, that's bullish. Well, no. I mean, there was an awful lot of upside at the beginning. But the thing is, had it been, if that sort of rule applied, then at 1810, the outlook was incredibly bleak. The market was down 300 points. The bulls didn't have a prayer. Clearly, that wasn't true. And if it wasn't true then it's not true now. So recency bias will keep you from buying when it is cheap and from selling when it's expensive, because it will lead you to believe that whatever is happening will continue. But you cannot analyze by extrapolation. It will usually fail. And the fact is, if you look at any market chart, you never see it go up in a straight line from the left to the right or down. The fact is, you know, there will always be reversals, short ones, big, you know, small ones, big ones, whatever, and you can make a lot of money on those reversals. And I mean, obviously, you've got to be realistic about it, and you've got to look at it with a cold head, and your analysis has to be good. But nonetheless, there are a lot of advantages to that, and if you miss all the subtleties of it, then it's going to be difficult to come up with a realistic plan. The other thing I wanted to talk about was. Sorry, I had it in my mind a moment ago. It is gone.
Okay. Just to close, I think if I could just emphasize a couple things, and then Mike, anything you want to say to close. I think there are questions that you have to ask yourself before you ever put money at risk, and there are just a few questions. And just really to simplify all of this, okay? Number one, do you have a trading plan? I mean, a real plan in terms of, you know, if this level happens, I'm going to do this. If this level happens, I'm going to do that. That's number one. Number two, do you have a money management plan? Meaning, how much do you risk? And also part of money management is taking profits. And do you have a system for taking profits along the way? And number three, the third question is, do you review your plans after you conceive them? Okay, I think if you can do those three things, and it's very simple. It's like having a trading plan, having a way that I'm going to manage my money in terms of how much do I put on, how much do I take off, and then after the fact, objectively at 10 o'clock, reviewing your plans and actually learning from your mistakes. I think if those three things are present in the way that you trade, you're going to learn to be a good trader eventually, okay? And of course, I think hanging around more experienced traders helps you learn along the way as well. So that's what I wanted to say in closing. Mike, what are your thoughts?
Okay, sorry. I thought it was. What I would say is, this is a very difficult thing that we do, but it can be, you know, very rewarding. And the thing that I would suggest is just to start small, to build on the little successes and make them larger and larger, to try to be as self-aware as possible, have a plan for when things aren't going well, know who you're going to talk to about when it starts to not go well, and always your first question is in your mind is, what is my risk? What is my risk, and how am I going to get out of this if it doesn't go well? If you take care of those things, the winners will come. Mm-hmm. The winners will come. And, you know, that's, you know, and through that, you know, you'll have consistency and have, you know, just all the things that we've talked about. It can sound overwhelming, but at the core of it, you just have to you know where you're wrong. Know where you're wrong.
Exactly.
And understand that if you think you're wrong, and just get out. Get out, reset your head, reset everything, get that instrument back in tune, and then go ahead and find the next setup.
Yep. Manny has a question here about planning templates. We'll post something, Manny, in terms of a trading plan, okay, a basic trading plan. And guys, I want to thank you. This has been great. Everybody, thank you for attending. We've reached our 1 hour limit. And guys, we'll be posting this webinar on the front page, so you may want to refer to it later. So Jack and Mike, thank you guys. Well done.
Thanks, man.
Yep.
Thanks for coming, everybody. Thank you.
All right. Bye-bye.
Bye-bye.